And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's another week, and it's also a holiday shortened week this week because Friday is Good Friday this weekend, right around the corner. Easter Bunny's coming. Big debate right now on the internet, at least according to my local Facebook page, is over the cost of eggs for Easter, right? So everybody needs something to color. So I was listening to some commentary this morning, and one of the suggestions made is use potatoes. They're about the same size as eggs. You get the little small potatoes and you can color those. So nothing excites children like on a Sunday morning of going out and hunting for potatoes.
This spud's for you.
Exactly. So the other suggestion was use rocks. So how about just, if eggs are really too expensive, use the plastic ones, you know, they're out there. So yeah, but this is the time of year where people leave out the marshmallow little peeps. Yeah, you leave those out for like a week or so before, and then you have peep fights with those because they're just like throwing rocks at each other.
No kidding.
So anyway, Easter traditions all coming up here soon. So whatever you're doing, but Friday market is closed, so we'll have just a short trading week this week, Monday through Thursday. So we've got a lot to get in this week before the week wraps up, and of course traders are going to be working off a holiday shortened week as well. A few things happened over the weekend. On April the 3rd, one of the big concerns, of course, was on tariffs. And I know April 3rd seems like a millennium ago right now. But on April 3rd, there was a lot of concern about tariffs and particularly the impact on Apple. Apple was down sharply during the recent downturn because of their amount of their products that they get from China. In fact, Apple was putting tons of products on jets and flying them over here ahead of the tariffs to get them into the U.S. for distribution. Over the weekend, so back on April 3rd, Citi came out with one of their analyst notes and made a very important statement. Says if Apple is not exempted again from tariffs, that we may see a much bigger downside draw on Apple, and because of its impact of tariffs on their products, because they do so much manufacturing at Foxconn and other stuff in China and other Asian countries to make the iPhone. So the iPhone was really at risk here, and that's a big seller for Apple, obviously, in the markets. And so one of the things that Citi had put out there is that we needed to exempt, and this was an interesting statement because, again, if you go back to the first time we did tariffs, Trump exempted Apple from tariffs because of Apple's commitment to manufacture more in the States. It never really happened, but they kind of committed to do it back then. Well, Tim Cook had met with Donald Trump this time around as well and said, hey, we're going to invest $500 billion in the U.S. and all this, make a good gesture with the government. And again, this isn't surprising, right? I mean, companies do this. Who's ever in charge of the administration, the companies are going to, make deals with them to make sure they keep government contracts or keep regulation where it is, whatever's going on. And so Trump instituted these, 125%, 150% tariffs now on China, which was a major impact for Apple. And of course, over the weekend, surprisingly, I'm sure some phone calls were made. Those tariffs have been exempted now on electronics. So for the most part, now Trump's saying he's going to put tariffs come back on later. They may be different, but whatever it is. But for right now, Apple's been exempted from these tariffs. Apple will be up about 5% this morning. And part of this issue is the question now is like, do these tariffs actually ever come back? The mistake, as we discussed here a lot on the show, was using tariffs and substituting trade deficits for tariffs, which they aren't. China is now the major trading partner with the world. U.S. used to be, it's now China. And so that trade deficit that exists between countries is there for reasons we talked about previously. Has really nothing much to do with tariffs. It's just that some countries we need to import stuff from, and we need to import more stuff from them than we export to them, so you get a trade deficit, right? That's just part of the trade balances. But again, these tariffs were a very, very different thing, much more draconian than the market expected. That's what led to the big sell-off. And now we're starting to see the reversal of those tariffs. And that's been giving the market here some relief, and we'll talk about that this morning, but we're getting some of that relief. In fact, here's what you need to know before the bell. So again, market sold off very sharply on that more than expected tariff rate that was put on other countries. And now, of course, we've had that repeal of that. So after that very big drop off, we were down about 10% already in the markets. And then, of course, it took another 5% blip on top of that, during that whole tariff sell-off. So certainly very painful for markets. Then, of course, we had the relief rally that took us back up to basically about the bottom of that previous trading range. So we wiped out most of that tariff decline in a single day when those tariffs were repealed for 90 days, and we just had basically just the 10% tariff on all countries other than China. The market then sold off a bit after that kind of relief rally, then rallied back on Friday. This morning, markets will be basically trying to retest the bottom of that previous kind of consolidated trading range. And this is really kind of where markets are trying to work themselves back to. Markets are looking up to be about 1.5% this morning, so we'll see. But we're going to start kind of pushing back up into this previous resistance level now. So markets will have some work to do here. We are getting close to triggering a buy signal, and markets are not overbought. So there is some room here to lift markets a bit. And what would be healthy if we could get back up in this 5,700 range, that would be ideal. So again, markets have some room to recover here. And as Trump repeals these tariffs and sees this recovery in the markets, likely what we'll see here is these tariffs just don't come back. There'll just be some type of announcement that deals have been cut with countries and everybody's all excited, and we've got lower tariffs with these other countries. We may not ever know what all these deals are, because apparently there's like 100 countries now that are wanting to do deals. So we may never know what all the deals are that were made. We'll just have an announcement that, well, tariffs are now, just going to be where they are, and this is just going to be kind of the new order of this, and markets can kind of move past this. And again, with some stability in the markets and stability in these tariffs, we can start getting a little bit better handle on what forward earnings are going to be. And we're starting to see estimate revisions coming in for that. And again, we've got some more work to, Wall Street has some more work to do here in terms of revising those earnings estimates down to account for these tariffs, what that might mean for corporate profitability. So again, markets may struggle here for a bit, kind of be on the struggle bus for a month or two until we kind of work through all of this and kind of get some clarity, some final clarity, I should say, on what the future for tariffs look like, and then markets can kind of start to recover. Valuations, expectations have come down. The market has repriced valuations to a good degree. We've got a lot of companies that were overvalued now trading at undervalued relative to their fair value. So we'll start to see some money rotate within the markets as well. The bigger issue, and one we'll talk about this morning, are credit spreads, which because of the turmoil that's happening in the bond market. We talked about the basis trade last week in the weekend newsletter as well. Went through a pretty good description of the basis trade for you. That's in the newsletter that we just posted out this weekend. But that is going to be kind of weighing another kind of risk for the markets here near term. If we can get that resolved, then markets are going to start having a much better outlook. But for now, at least for the next month or two or three, kind of expect a bit of struggle with markets, a bit of turmoil here, continue to manage risk. We're not out of these woods just yet, but just because the markets are rallying back, we're having this reflexive rally, we're not out of the woods just yet. So be a little bit cautious for now, and then we'll kind of work through this as we go. But that's what you need to know before the bell this morning. When we come back, we'll pick up about yield spreads, what's going on with those, the risk in the bond market that still exists right now, and what might happen next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I don't know if you know who Bill Maher is, but he does a show on HBO. He's pretty much a kind of a liberal centrist, more or less, and he has, kind of long. He's not a big fan of Trump, obviously, and for a long time he's made a lot of comments about the Trump administration, and both in the previous administration and this administration. Anyway, President Trump invited him to the White House. And the liberal left is just going nuts over this because he came back from that meeting at the White House and said, Trump is not who I thought he was. He's very gracious. He's smart. He listens. He asked me what my opinions were. We had good conversations. But the funniest part of this whole thing, and he posted that he had the whole segment on his show talking about his trip to the White House. But the funniest thing is that he took a piece of paper with him. And on this piece of paper, he had 80 derogatory statements that Trump had said about him. He's terrible. He's awful. He's blah, blah, blah. And he took it to President Trump and had President Trump autograph it for him. And he was happy to do it. And so, it was good to see. I mean, the two guys who absolutely disagree with each other on a lot of different fronts came together, had a conversation, and had a good outcome from it. But him citing these derogatory statements was classic. Anyway, so just for the break, talking a little bit about yield spreads. And so a couple of things that are going on. First of all, the stock market's been under a lot of pressure, from the headline news at least, over tariffs. But one of the drivers for the economy is credit, and it's the most important driver for the economy. And the stock market does not drive the economy. The stock market is fun, it's exciting, we all buy it, blah, 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 but it's credit that moves the country. I mean, it's, we borrow money to build factories, we borrow money to buy houses, all this, everything that we do is revolving around credit in some sort. So paying attention to what happens in the credit market is the most important thing. And we've talked about the importance of yield spreads before, which, yield spreads are simply the difference between yields on two different instruments of the same duration. So, you take a 10-year treasury and a 10-year corporate bond. What's the difference in the spread? Those spreads should be different, or those yields should be different on those two instruments because there's different risk. Treasuries are inherently what's considered the only risk-free investment because the government will always pay you back. And corporations, they can go bankrupt. So there's a risk. So if I buy a corporate bond, I should get paid more for the risk that I take in that bond than I should get paid for owning a government treasury, which is considered to be risk-free. There's also other factors in those. I should be paid for how much time I loaned the money for. What's the default risk, as I just said? Is this company at risk of going default or, whatever? What's inflation? What is, of course, also things like opportunity risk? All those factors, economic growth, all those factors are factored in to the yield on a bond. So if you go to the bond market and you say, I want to buy a 10-year bond, say it's an ExxonMobil bond today, and ExxonMobil says, okay, great, I'm going to borrow some money from you, because this is what a bond is. The bond is basically a loan between a borrower and a lender. And so ExxonMobil says, Jim, I'm going to borrow $100,000 from you. And so you buy $100,000 worth of a bond from ExxonMobil. You loan them the money for 10 years, and they give you an IOU, because that's all a bond is. A bond is just basically an IOU that says at some point in the future, I'm going to pay you interest payments. At some point in the future, I'm going to give you your money back. And then we'll be done. That's all a bond is. It's that simple. Well, you can't change that rate once you make the loan. So that interest rate has to factor in inflation costs, risk, economic growth, opportunity. All those things have to be factored into the yield at the time you make that loan, because you're stuck with it for 10 years, in theory, right? Just in theory. So there should be a differential between those spreads. Well, when markets are really good and everybody's all excited, then we kind of start forgetting about the risk part, right? It's like, oh, no risk here. And so the yields start to compress to be very close. In other words, and we've talked about this before, is that when yields are very compressed, you're not really getting paid to take the risk. Like, for example, like a couple of weeks ago, we were talking about muni bonds here on the show. And the difference between a tax-free muni and a taxable treasury is so low, you're not really getting paid for the default risk that exists in muni bonds. Even though that risk is really low, there is still risk there, and you're just not getting paid for it. So for the differential, you might as well just buy the risk-free treasury and just going down the road, right? So paying attention to credit spreads is important, because when those things start to change and we start to see a widening of the spreads, and all of a sudden the bond market is realizing, hey, there's more risk here than I was willing to take before. And so I'm now going to require higher yield for this corporate bond versus a treasury bond. That tells you something about the economy, right? That's telling you that default risk is rising. It's telling you that credit risk is rising in general. And that increase in spreads as a very good leading indicator for market stress, economic stress, financial stress. So here's a chart of the treasury bonds versus corporate bonds. So BAA yields, those are corporates. And definitely have seen an uptick here recently. Now, importantly, two things is that, yes, the yield has ticked up. Certainly certainly tells us there's some stress going on in the financial credit markets. In particular, we saw this with, kind of what's happening with this basis trade that we discussed last week, certainly feeding over into the corporate bond market. But that yield spread is still well below the long-term average. So there is stress, but we're not at alarm levels yet. Now, this is a Friday's close, so this will change some today. But importantly, when you've seen sharp increases in yield spreads, they have been coincident with other issues occurring in the markets. And particularly when they move above the long-term average, you're typically at levels that have suggested that risk is much more present in the markets. Now, that shaded area in the background, that is the annual rate of change in the S&P 500. And you'll notice that when you have very sharp spikes in credit yields, it generally revolves around a negative return in markets. So again, we're definitely seeing that. But now, if we move this and we look at, now this is risk-free yields versus corporate bonds. So good quality investment grade corporate bonds. But the real indicator is high yield bonds. What's the difference between risk-free investments, treasuries, and junk bonds? Because junk bonds is a proxy for the stock market. And there we're still seeing that yield spread rise sharply, still well below the long-term average, but definitely starting to show some signs of stress. So there is certainly some credit stress that is occurring within the markets. That is a risk for banks. That is a risk for hedge funds. That's a risk for equity prices. Again, still contained at the moment. Not out of control as of yet, but certainly rising to a level that we should be paying attention to. And again, we've talked about this before, is that this is the one thing we watch more than anything else relative to the markets, because this is your leading indicator for market stress. Again, now we've seen increases like this before that didn't revolve into much of anything. 2005 through 2007, we saw an uptick, and then markets kind of calmed down again. We saw it during 2018 when we had the whole Fed taper tantrum. It actually rose up to the average, but that was about it. The Fed stepped in. But that's going to be the question, is that we haven't seen the Fed step in yet. These spreads are rising. We certainly have the basis trade going on that's weighing on hedge funds. We've seen a very sharp, unnatural increase in yields over the last week, bond yields in particular. We saw those move up to 4.5%. That shouldn't happen in an environment where you have PPI and CPI basically falling out of the bed at the moment, towards disinflation. But you saw that because that was that stress. There were margin calls going on with hedge funds over the last week, creating forced liquidation in treasury bonds. Now, has that gotten under control? Maybe. We haven't seen any action, any response from the Fed at this point. So maybe behind the scenes, there's a good bit of work going on that we don't know about, which is certainly possible. But we'll see this week. We'll be watching, yields on the 10-year Treasury very closely this week, because again, that's going to feed over into this risk dynamic in the credit markets. And as we talked about before, tariffs are one thing, right? Tariffs are a short-term impact. I can put tariffs on countries, and now we've pulled them back off, and we keep doing all this other stuff. But tariffs are fine, because that just is something the market can factor in. Credit risk, as we've always said, is the big thing to watch, because that affects the banks. That has a much bigger impact on economic outcomes. If something blows up in the credit market, that's your big risk. And again, got to go back in history and with looking at those yield spreads. Big spikes in those yield spreads have always been coincident with some type of market risk off event. So again, we'll see. Maybe we're not to any degree of magnitude just yet, but certainly something worth watching here. And again, while we may get a bit of a rally here over the next couple of days just because markets were very oversold, you're getting this kind of reflexive rally that's going to cause shorts to start to cover. That could push asset prices a bit higher. We're likely not out of the woods just yet on this corrective process. Maybe we are, right? Maybe we are. Maybe the market just rockets right back up to all-time highs. That's very possible, right? But the risk that's building underneath the surface suggests that's probably not the case, and that we've got more work to do before we get this period of turmoil, shall we say. Markets in turmoil, CNBC headline. Get that behind us. We've got more work to do. All right, we'll come back. More stuff to get into. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, have you seen 1923 yet?
Yes.
I have a major beef with 1923
Uh-oh,
on
okay.
multiple levels.
The Real Investment Show podcast.
The stuff that was happening in that show would not happen to normal people, ever.
We were watching that too, Shauna and my wife. This is so exaggerated. There's no way that this would happen in real life. This Taylor Sheridan, boy, he exaggerates it. I'm just like, just watch it for what it's worth.
Very entertaining. Just at the end of it, I was very frustrated at the end of it. I was like, after all they went through, can they just be together?
Yeah.
At realinvestmentadvice.com.
I digress. Credit spreads, though. But this is the issue with credit spreads, right? It's the 1923 version of credit spreads, which is we got to make it so dramatic.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. So just talking a little bit about credit spreads a second ago. Some comments in chat this morning that the Fed's hands are tied. They're not, by the way. That's a lot of rumor that market puts out there from time to time. That collapse in CPI to 2.4% last week and that sharp drop in PPI, Fed's hands are not tied anymore. If your concern was about a resurgence in inflation, that is off the table as far as the Fed is concerned now, because they are rapidly approaching their 2% target. And with this recent turmoil in the markets, that's going to push CPI even lower. If you take a look at what's happening with consumer sentiment, which is what drives the economy, that's falling very sharply now. Expectations of future financial health, expectations of future jobs, all just dropping to new lows at this point right now. So consumer retracting very, very quickly, which is disinflationary, which gives the Fed plenty of room to start cutting rates as soon as May, which is first week of May, I believe, is the next meeting. So they certainly have the ability between now and then to start addressing the credit market if credit markets continue to disrupt. Now, if credit markets get back under control here, which is possible, right? If these hedge funds can negotiate this whole unwinding of the basis trade, get out of it, get things back on track. If yields drop here, that'll certainly help alleviate some of the pressure. That'll give the Fed plenty of room to be patient and just kind of follow their plan. If it doesn't, the Fed will come in, they'll cut QT to zero immediately. They'll cut rates by 25 to 50 basis points. If that doesn't solve the problem, then they'll revert back to QE, become a buyer for hedge funds. And that may have actually already be happening behind the scenes. One of the charts that we, kind of track every now and then is the Fed Liquidity Index, which is rising sharply right now. There is liquidity being put into the financial markets as of last week. Now, we don't see it on the surface. It hasn't really been announced, but we're definitely seeing a very sharp uptick in Fed liquidity into the financial markets, which has been supporting this rally over the last few days. Now, again, we'll see what happens, but this idea that the Fed's hands are tied, they can't do anything, that's not true at all. So just be careful with that. Economic policy uncertainty, of course, has been one of the key drivers of this sell-off. Here's a chart of economic policy uncertainty versus the S&P 500. You'll notice that very sharp spikes in economic policy uncertainty correlate with market sell-offs. We currently have one, the spike in economic policy uncertainty is the highest since the pandemic, right? The pandemic was a record surge in economic policy uncertainty because, you shut down the economy. Makes complete sense. Far above what is normal levels of economic policy uncertainty, like we saw during the financial crisis or the dot-com crash. We're approaching levels we haven't seen since the shutdown of the economy in 2020. And yes, markets are down. That's not surprising because markets are having a real difficult time here figuring out kind of what goes next. But this feeds into earnings. And Wall Street is having a very difficult time. You can change charts. Is having a very difficult time right now trying to predict what earnings are. Now, we're right in the midst of earnings season for quarter one. Quarter one earnings are pretty much already done. Goldman Sachs just announced their earnings came in pretty much in line at this point, announced a $40 billion buyback. JP Morgan announced on Friday. But this is analyst estimates for quarter one over time. They started out at $226.54 a share in March of last year. As we now approach earnings, we're down to $217 for first quarter. This is from S&P. So this is these are the estimates, GAAP reported estimates from S&P, the people who run the S&P 500 index. So this is their estimates. But we're down to 217 in terms of what S&P is expecting for earnings. Now, interestingly enough, that correlates as we start talking about now, again, you think about last year at 226.54. That's where we started estimates for quarter one of last year. Now, going into quarter two, we're expecting that we're going to see $223 a share for earnings in quarter two, right? So quarter two's earnings are actually lower than where quarter one earnings were a year ago. But hey, markets are a lot higher since then, so it's all good, right? We don't really care about that. But here's the interesting thing. Is that what they're looking for right now is that in quarter three, so we get through this quarter, get through next quarter, no impact from tariffs on that for some reason. But for some reason in quarter three, we have this tariff impact show up in quarter three earnings, and we see earnings drop to 179.26. Now S&P right now, and again, this could be an anomaly in their data, whatever, but it's highly unlikely. But they're expecting an immediate recovery back to the previous trajectory of earnings growth. So we'll have some type of short-term, what they're expecting is a short-term blip in economic impact to earnings because of what's going on. And then immediately the economy will start recovering and we'll be fine. So tariffs are a short-term impact. They are quickly resolved, put away, repealed, whatever it is. And then we go back to growing the economy. I don't think this is realistic. This could be an error in their data. It's possible, right? But I think this is the first salvo in them trying to figure out what the impact of tariffs are going to be. And that long end of estimates are going to come down sharply, probably closer to, instead of 284, probably somewhere close to 230, maybe 240 being their estimate. So we'll kind of see how this goes over the course of the next few months, and we'll keep you updated on this. But the analyst estimates for earnings have yet to come down to any sharp degree going into 2025, the end of this year or really next year, outside of this anomalous blip in the data. But the impact from tariffs is real. That is going to impact the markets. And what we're seeing from consumer sentiment, that's going to be an impact to the economy. Inflation is going to fall because of the lack of demand within the economy, which is going to drive all these earnings lower at some point. So again, we haven't seen the final assessment of this just yet, but this is something at least the analysts are starting to now try to figure out. But there's a lot more work to go, and this is what I was saying before. Is that when you start thinking about where we are in the market, this recent turmoil is not likely a short-term blip. This is something that is going to take a little bit more time to work out, and yes, even these sell signals that we get, these weekly sell signals, which is one of the reasons that we reduced risk in the portfolios last week when we had that big rally. We're now trying to figure out kind of what happens next. So, we'll hold a little bit more cash right now, reduce risk to bonds for the moment till we get through this credit crisis. Then we can rebalance everything. But, these blips that we've had in the markets, these sell-offs, they're either long-term events, can last 12 to 18 months, kind of like we saw during the dot-com crisis, or they can be very short-term blips, last a few months because of some anomalous impact, whether it was Brexit or whether it was the Eurozone crisis that got resolved, whether it was the end of QE1 and then restarting QE2, when the COVID crisis, when the Fed steps in. So the big driver for whether or not this current sell signal is the beginning of a bigger decline in the markets or a more protracted consolidation, like, say, we saw in 2022. And right now, because the Fed is still sitting on the sidelines for the most part, this still looks like the 2022 playbook, where the initial decline, you get a nice rally, everybody gets all excited again, and then you get the next decline, then you form a bottom, and then that's the bottom. That 2022 playbook, which took about 9 months to get through, is kind of what this looks like right now because of where we are. But if the Fed steps in, that could change everything. And the Fed does have that, as I was saying, the Fed is not on the sidelines. And if this credit risk issue becomes a bigger issue for hedge funds, and potentially that reflects on the banks, because the banks are the ones that provide the leverage to the hedge funds, the Fed will step in. And then this could be a much shorter term impact to the markets, one last 3, maybe 4 months, and then you're through this. But a lot of volatility between now and then, and a bit more market risk, which is why holding a bit of extra cash, reducing your risk a bit here certainly makes some sense. And yeah, we're going to miss the bottom, right? And that's okay. I don't have to try to nail the exact bottom of the market. I just need to make sure the risk is behind us. Then we can increase, allocations back up to, we would overweight coming out of this. We'll overweight equities, underweight fixed income at that point. But again, we got some more work to do before we get there. It's just a process that we'll have to go through. But again, sell signals are in place. I think we need to pay attention to those. You got credit spreads that are rising. You need to pay attention to those. And this is certainly not the buy the dip type market that we saw previously over the last, year or so, really 2 years, where every little decline was immediately met by buyers. This may be a little bit more protracted. Again, kind of looking at that 2022 model, this is 2022, and this first red line. And again, if you're driving, don't try to look at the chart. I've got the chart posted in today's article on the website. But that first red line on the left is where you had the initial sell-off, then you triggered the sell signal, which is what just happened in the market. So we're at this point of the market. You had an immediate rally that took markets back above those important moving averages, and then the market fell again and went to lower lows. And it was another 6 months before you actually got to the October 2022 lows. And again, while we were writing articles in October 2022 saying, hey, markets are deeply oversold here, super negative sentiment, time to buy, we have a lot of that extremely negative sentiment right now. So maybe this is a shorter term blip. That's why, again, we can't just assume what markets are going to do. We have to pay attention to it, because a lot of the stuff that it took 9 months to get to in 2022 has already occurred in just the last month in the current market. Super negative sentiment, extreme deviations to the downside, those type of things maybe has compressed this recent sell-off. But again, very likely while the market's recovering, we're going to have some type of pullback or retest of some level before this process is over. So again, this is what I'm saying. Just look, a lot of unknowns, but just be cautious right now. Come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So people are in the chat right now talking about getting banned on different channels. Yes, we will ban you. We have banned more than one person out of our chat. If you don't follow house rules, you will get banned. And homie ain't playing that game, right? So if you're annoying, you're being antagonizing, you're going to get banned, right? Be nice, be polite, stay on topic. You know, y'all don't stay on topic. I'll let that slide a little bit. We may have to crack down on that one a bit more. But, you know, we certainly enjoy you being in the chat. Just be nice, right? It's just, there's no reason to be ugly. And so if you get ugly, start making bad comments, or you start spamming stuff, we're going to ban you. And so there you go. You know, one of the fallacies, and this is one of our problems with the whole tariff thing we've got going on right now, is that we have this massively unfair trade balance with the rest of the world. And it's a reason we have that, right? It started with Ross Perot back when we did NAFTA, right? And Ross Perot even made the comment, says that giant sucking sound you hear, right, is us exporting jobs to other countries. And he was right. And NAFTA was a very poor deal that was cut for the U.S., and it led to this massive outsourcing of jobs. And the U.S. used to be the dominant trading partner in the world, right? Everybody bought their stuff from us. And when we started, and of course everybody else was complaining, is like, hey, you know, it's not fair. And so we did this whole NAFTA free trade agreement, blah, blah, blah. And that opened up the doors to start outsourcing all of our jobs to other countries to get reduced wages, reduced costs. We could export, but having said that, that is what has given you the ability to have a well above average standard of living, far above and beyond the rest of the world, because we've been able to export inflation to import deflation. Here's a chart of the world in 2000. This was trade, and U.S. was the largest trading partner in the world. Canada bought from us. South America bought from us, Africa bought from us, Russia bought from us. Australia, everybody bought from us. And that has been eroding over the years because of our ability to outsource labor to the cheapest provider. And other countries are able to provide cheaper goods and services than what we can provide here in the U.S. And so there's this whole idea, this whole thought process that we can reverse this process, right? So whether it's tariffs or whatever it is, we can reverse this process. You can't, because we demand too much for labor. Everybody wants high salaries. Everybody wants benefits. You want time off. You want parental leave, maternal leave, this leave, that leave, paid vacations, all those type of things. But those are all costs, right? Those all have to be factored into the production of goods and services. So it's great that you want all these things. You want the 401k plan. You want the pension plan. You want the health care benefits. It's all great, right? Nothing. I'm not saying you shouldn't have that, but it is a cost. So we can't manufacture here like we used to back in the day because of those reasons. We have to be able to export inflation to import deflation so you can maintain your standard of living. Here is the world today in 2024. The U.S. is no longer the most important trading partner in the world. China is. Because they've got 1 billion people that will work for $2 a day to manufacture products. You're not changing this. We can try to impose tariffs. We can try to do all these type of things. It's fine. But again, as we said before, tariffs are one thing. And again, if I've got no problem with this, if in a lot of countries they impose tariffs on our products. If you want to buy a U.S. car, you're going to pay in Europe, you're going to pay a tariff. That's why you don't see a lot of U.S. cars in Europe. So I've got no problem with you if you want to try to, equate that, right? You take off your tariffs, we'll take off our tariffs. That's fine. That's the goal, ultimately, free trade. But we're not going to change the dynamic back to where it was because simply we can't afford to. We want too much, we demand too much, and we want a cheap standard of living. We want what's, in colloquial terms, Pax Americana, this wonderful environment that we've lived in for the last 40 years. A lot of it's been funded by debt, but that's globally. That's not just in the U.S. But it's been to the ability to outsource inflation and import deflation. I can buy, 57-inch television, 65-inch, 100-inch, whatever television I want for a couple of $1,000s versus trying to make it here. Estimates on an iPhone. You want to make there was a comment made by the White House today. It's like, we can just start manufacturing iPhones here. No, you can't. Right now, I go buy an iPhone for about $1,000, $1,200. You want to manufacture that here, it's probably $3,500. What happens to iPhone sales if iPhones cost $3,500? That's the problem. So you have two choices. One, you start equating and aligning labor cost with that of the rest of the world. But who wants that? Maybe you reduce some tariffs on maybe other countries reduce their tariffs. That'll help a little bit. That'll help with free trade, right? Exports are 41% of corporate revenues. So if you remove all the tariffs, exports become a larger chunk of our corporate revenues. That's good, right? That will help for certain. If we could take export revenue from say 41 to 50 or 60% of total corporate revenues, certainly beneficial. But this thesis that we can somehow return the America back to the glory days of the 50s and the 60s when we were the manufacturing powerhouse of the world is not really a valuable goal. Because, again, the world is entirely different than it was back in the 50s and 60s. 50s and 60s, we had bombed the rest of the world to oblivion. They didn't have any manufacturing. We were the only source. And we didn't have, back then, 401k plans and healthcare plans and all these other type of benefits. People earned a wage, they went to work, they produced stuff, they manufactured stuff, They got paid. My dad made like $8,000 a year back in the 50s and 60s when I was growing up. And that was an average wage back then. I mean, people lived in houses that were 1,100 square feet, 2 bedrooms, 3 bedrooms, 1.5 bath. Didn't live in these big mega mansions, right? McMansions. People didn't have $300,000 and $400,000 homes back in. They lived in $35,000 to $50,000 homes. And again, you have to inflation adjust that over time, but you get the point. Things were more reasonable. Expectations were more reasonable. Living standards were more reasonable. People lived within their means. The average debt to income, or debt to net worth, I should say, was about 60% versus 160% today. So people lived within their means. So the economy could grow. Things functioned. And yeah, we were the exporter. We were 80% of the world's of America's economy was about 80% manufacturing. We were the major manufacturer in the world. We made blue jeans and televisions and everything you can think of. And we exported that. But then we said, hey, you know what? To boost corporate profitability, if I can manufacture this stuff cheaper, and again, as transportation improved, and of course, remember in the early 80s, we launched FedEx. All of a sudden, I could get stuff overnight, and I could switch from maintaining inventory to just-in-time delivery. So now we just maintain minimum inventories because we get here so quick until something blows up, like you shut down an economy. But all these changes have made our lives better. Absolutely. We have more conveniences. We have the internet. We have technology. We have all these fantastic things that we take for granted that other countries don't have. Our living standard is far above and beyond most other countries. And we take that for granted. But that comes at a cost. So now we're trying to realize or realign and trying to move back to where we were as a major trading partner with the rest of the world, but that doesn't come easy. And the question is it even possible? Because the dynamics in the economy are not the same as they were back in 2000, back in 1980, or even back in the 60s. This is going to be one of the big tests of this administration and these ideals, which, there's nothing wrong with the ideal, right? When you take a look at the impact of China as a major trading partner with the world, you certainly have to go, well, that's probably not a great thing. And I don't disagree with you. The question is how do you reverse that? And how do you do it with the least amount of economic pain and destruction in that process? I don't have the answer for you. But we'll see. And it's going to be interesting to watch as this administration kind of goes through the throes of trying to figure it out. Because the first attempt didn't work. So now we've done a reset. We're trying to pull it all back, get to a restarting place, and we'll figure out what happens next. But this is what I'm saying. That the risk to the markets ultimately is the unexpected issues that come from policy changes. So that economic policy uncertainty index, people watch on that. All right, that wraps up the show for the day. Get by the website. Our Tuesday article is out today, so it's timely for the market, especially since it's a shortened week. Have a great day. See you back here tomorrow.